Over the years, I've tried just about every type of option trading strategy there is. Naked calls, condors, butterflies, cash secured put options. But there's one strategy that I always keep coming back to because it's consistently profitable and throws off really nice monthly cash flow. That strategy is the option wheel strategy. And it's a strategy I use in over 70% of my trades. In fact, as you see here, I've collected over $595,000 in net option premium over the past several years using the wheel strategy, as well as a couple other ones. In this video, I'm going to show you how I trade the option wheel strategy for consistent monthly cash flow and returns. Here you see my real life position in OTEX over the past year and a half or so. First, I'm going to show you what the optional strategy is, and then I'm going to show you my techniques or how I trade it for consistent cash flow and returns. Now, I've color-coded this Excel spreadsheet for you to make it easier for you to understand. The blue shaded areas, that's where I've sold put options. That's step one of the optional strategy. You sell a cash secured put option at a strike price that you feel comfortable owning the stock at if it came to that. Now, if the stock ends up above the strike price of the put option you sold at expiration, then the option expires worthless. You can start the process back over again by selling a cash secured put option in that stock or a new one. For many trades we do, that's really all the optional strategy consists of, is selling cash secured put options against stocks that we feel comfortable owning if it came to that, at strike prices we feel comfortable dealing with them or buying them at if it came to that. I then set a limit close order to try and close it out early, and generally that's what happens. For example, here you see a series of trades in ticker symbol CME. Over about a 5-year time frame, we did a bunch of trades, over 30 trades. We're only assigned one time for a couple months. Otherwise, we sold a cash secured put option and then either bought it back early to close it out for a nice return, or rolled it out farther out in time, or just let it expire worthless. And generally, that's what happens when we sell cash secured put options. You're kind of stuck on step one of the optional strategy, and that's just selling cash secured put options. I'm going to show you some examples of this just over the past week and a half or so where I've closed out cash secured put options that we have bought early. For example, here you see one in Amazon that we closed out early for a nice profit. Here's another one in Tesla that again we closed out the cash secured put option that we sold about a month or so ago early for a nice profit. And we have two of them here, one in MasterCard, another one in SPY that again we closed out early and it wasn't assigned to us. Then here's an ETF we sold a while back. We closed out early, XLV, for a nice profit. And let me give you just three more that we've done just over the past week or so. We've closed them out for a nice profit. Here's one in ticker symbol CB. We closed out for an over 90% win. On the 3rd of September, one in IBIT that we closed out for again another 90% win. Then one more on Google that we closed out a couple of days ago, again for a nice 90% win. So as you've seen in step one of the optional strategy, if done right, you can close out a lot of your cash secured put options for nice wins early. So that's what happens if you close it out early or if the option expires worthless, as you see happened a bunch of times with CME. However, sometimes, even if you're trading the optional strategy in the right way, you'll eventually still be assigned some shares. And that's the example I want to talk through with you in this video. And the ticker symbol is OTEX, as I shared with you earlier. So we had sold multiple rounds of cash secured put options. But then the cash secured put options were assigned to us, and the only reason they were assigned is because OTEX was below the strike price of the put option that we had sold. So as you see here on May 3rd, we were assigned 6 put option contracts worth, or 600 shares of OTEX, and we bought them at the strike price of the put option we had sold, which is a $35 strike price. So now we've moved on to step 2. We've been assigned the shares of the stock that we had sold put options in. Now it's time to move on to step 3, and that's to turn them into a covered call. On May 8th, I sold the next month's covered calls against the 600 shares that I owned. So I sold the third Friday of June, $32.50 covered calls. And for that, I got 30 cents per share. Now, one thing to point out here is that I was assigned these shares at $35 per share. And I'm selling a covered call below the strike price I bought the shares at, because I'm selling them at $32.50 per share. So just keep in mind that if you sell a covered call at a strike price below where you were assigned the shares at, you could possibly have a loss in that stock if they were called away from you at that price. However, my plan here was to not allow it to happen. My plan, as you're going to see later on, was to roll that covered call strike price back up when OTEX began to show strength, and that's what's happened recently. That's why I wanted to share this example with you. So we collected nice cash secured put option premium up in here. We were selling those put options, and then we were assigned shares of OTEX at that $35 strike price we had sold the put option at. And then we began to sell covered calls. Then once we were assigned those shares, we began to sell covered calls against the stock that we owned. And as I scroll up here, since it's a dividend paying stock, When we own the shares, we also collected several rounds of nice dividends in OTEX. Now personally, I have a very strict position sizing rule that I stick to. I don't want to have at risk in any one company more than 5% of the total capital I have set aside for that account. But generally I start positions out with around a 2 to 3% of the amount of capital I have set aside for that account. That means that if all the put options I sold were assigned to me, like they were here, then I would only have 2 to 3% of my max capital in that account at risk in that one position. That leaves me an additional 2 to 3% to adjust the position if I need to. And in fact, I needed to later on in this trade, as you're going to see here in just a minute. So we're sitting in a covered call here with OTEX. And because it's a dividend paying stock, we're collecting dividends since we own those shares. So now we're just watching our covered calls because we don't want the stock called away from us at a price that we're not happy with. And my goal in this situation was to have it called away from me at lowest at $35 per share. And I really needed to watch this position because as you see here, I was selling covered calls at $30 per share. That's because the stock had gone down so much. And just so you see what was happening with the stock chart during the time I've been in this position, let me show you the daily chart of OTEX. Back over here on the left where the yellow up arrow is, that's the day that we were assigned those shares or had to buy those shares at $35 per share because the put options were assigned. And as you can see here, over the next several months, OTX really took a nosedive. It was down almost 40%. And that's one reason why I wanted to share this position with you, because it's one that has been pretty challenging. But I was still comfortable staying in this position because I believe that long term, OTX was very undervalued. And in fact, to this day, even though it's trading today at around $35 per share, I still believe it's very undervalued. In fact, I believe it's worth about $45 per share. So finally, after declining about 40%, the market kind of saw what I had seen. And since that time, OTEX is up about 50%. So we'll see how this position plays out. I just want to show this chart to you so you can see what happens when positions go against you in a pretty big way, as you see here that OTEX did to me. Now, a couple basic things I want to make sure you understand here for those of you that are newer. When you sell a put option like we were at first, you're basically selling someone insurance. You're telling them that no matter what price OTEX is at, between the day you sell that put option to them and the day the option expires, you're sitting there waiting, willing and able to buy those shares at that strike price. In this case, we sold the third Friday of April, $35 put options. So we sold them insurance up to $35 per share in OTX during that time frame. And for that, they're going to pay some option premium. In this case, it was 69 cents per share. Well, kind of the reverse happens when you do a cover call. You're selling someone the right to call your stock away from you at some price between the time you sell it and the day that option expires. For example, if we just take this line here, on May the 8th, I sold the third Friday of June covered call at the $32.50 strike price. That meant the person that bought that call option from me had the right to call or to buy my shares from me for $32.50 per share at any point between the day I sold it and the third Friday of June. But to give them that right, they again paid me option premium. They paid me 30 cents per share. So with the wheel strategy, you're really banking on collecting nice option premium when you sell put options and when you sell cover calls. Another technique I like to do with cover calls is to kind of work the strike price of the cover call. If a stock is declining, then I'm willing to sell cover calls at strike prices below where I bought the shares at. Remember, I bought these shares at $35 per share, but with OTX being down up to 40% below where I bought it at, I was selling some cover calls as low as $30 per share, as you can see here. But I was watching to see once OTX switched directions like you saw it did and began to head in a bullish trend, at that point I was rolling my cover call strike prices back up. And so here you see the trade I did yesterday, and I actually rolled that cover call strike price back up to the same price that I bought the shares at. So if the cover call I sold yesterday is a sign, I'll sell my shares for $35 per share, as you see here. So here's the step-by-step breakdown of the option wheel strategy. Step 1, you sell cash put options in a company you feel comfortable owning if it came to that. Step 2, the put options either expire worthless or you close them out early. If that doesn't happen, that means the stock is trading below the strike price of the put options you sold. In that case, if you did nothing, you'd be assigned those shares or you buy those shares at the price of the put option. And then once you own the shares, you sell covered calls against those shares and you repeat that process until the shares are called away from you at the strike price of the covered call option that you've been selling. And the way you get paid is by receiving that option premium whenever you sell a put option or sell a covered call. And if it's a dividend stock and you own the shares, you'd also be receiving the dividend. But there is one more way you can use the wheel strategy to profit, and that's from appreciation. And that's something I hope to do with this OTEX position. We'll see how it works out. Remember me telling you I thought the stock should be trading for around $45 per share? Well, I'd love to ride this thing all the way back up to $45 per share and then allow the stock to be called away from me. But right now, I'm short the $35 cover call, so we'll see what happens. But if you were bullish on a stock and you wanted to benefit from stock price appreciation, you can always sell your cover calls higher than what the stock's trading at. That way you get the benefit if the stock goes up in price, up until the strike price of the cover call that you've sold. And then once those cover calls are assigned, you just start the process all back over again, either in the same stock or in a new stock that you like. Here are several questions I get asked a lot that I want to make sure I answer for you because they are very important questions. The first one is, what happens if I sold a put option and the stock price never drops below the strike price of that put option? Well, if that's the case, then the put option expires worthless. You get to keep that premium. In fact, you get to keep the premium no matter what happens. But in this case, it expires worthless, so you get to keep the premium. You just kind of reset. You do it again in the same stock or in some other stock you like. And then once you've been assigned shares, another question I get asked is, what happens if the price doesn't hit the strike price of my cover call? So you own these shares, you sold a cover call up here, and the stock price never goes beyond the cover call strike price. Well, if that's the case, the person who owns that call option, they're not going to assign it because they can buy the shares on the market for even cheaper than the strike price of the call option they bought. So if that happens, you keep your shares and you sell a new covered call. Another common question I get asked is, can I use this on any stock? The answer is yes, as long as they have options, and most stocks do have options traded against them. But just because you can trade the wheel strategy, any stock that has options does not mean that you should. In fact, there's really only two types of chart patterns that I like to trade the wheel strategy in. The first type of stock I like to trade the wheel strategy in is one that pretty much trades sideways. And here you see a nice example of that with Realty Income, ticker symbol O. Notice it's been stuck in a range for several years between a high of around $75 per share and a low about $45 per share. So it is a relatively wide range, but overall notice that here recently it's been in a range between $65 per share and about $50 per share. So to me, this is almost like the perfect optional stock. It doesn't go way up and doesn't go way down, it kind of stays in a nice range. And here's the weekly chart of another type of stock I like to trade the wheel strategy in, and that's one we're seeing nice price increases. And this is the weekly chart of Amazon. So notice that going back to April, since that time, it's been a nice bullish pattern. So a company that I like, I think fundamentally has a bright future ahead of it, and it's trading in a nice bullish pattern. You just want to keep in mind that periodically it has these big sharp declines. But there are certain types of stocks that I do not want to trade the optional strategy in. Here you see an example of that with a company I really like, Hormel, but overall its chart pattern is terrible. Notice it's just been declining over the past several years. Now once this chart levels off or begins to go up, then I might become interested in trading the optional strategy in it again, but for now, I'm not interested. And the reason I'm not interested is because I don't want to be selling insurance on something that's basically declining. I'd rather sell insurance on something that's either trading sideways or going up in price. That improves the odds of me winning my option wheel trades. Here are a few more tips I want to share with you about how to trade the optional strategy to receive the most benefit out of it. The first one is you want to pick the stocks you trade in carefully. Now I just showed you charts, and charts are very important, but personally, I also don't want to trade stocks that are overvalued or overpriced. If I do want to trade in those stocks, I think there's other strategies that are better for it, but as far as the optional strategy, I generally don't want to trade them in overvalued stocks. I want to trade them in stocks that are either fairly valued or trading for about what they should be, or even better, stocks that are undervalued, like OTEXs in my opinion. Then another concept that I encourage you to learn is technical analysis, because that'll help you to time your entries whenever you sell those cash or put options, as well as placement of your cash or put option strike prices and your cover call strike prices. And I have a whole video series dedicated to technical analysis. So if you want to learn more about it, check out that video playlist. Then another concept I want you to be aware of is that you have the ability to close out your cash or put options early. I showed you a whole string of trades I've closed out over the past approximate week or so while realizing over a 90% profit in every single one of those positions. I was able to put that capital back to work in a new position, thus kind of doubling up on my return this month. And finally, I encourage you to only start doing the wheel strategy by selling put options in companies you'd love to own at prices you'd be happy to own those companies at. If you'd like to get an alert whenever I buy a stock or sell options, check out the benefits of becoming a patron down at the link in the description below. If you'd like to see some tips and tricks I use to find the best option wheel stocks, check out the video at the link above and the description below entitled How to Find the Best Option Wheel Stocks. Until next time, happy investing, and we'll see you again soon.